Hey guys, Joel Frank here, market analyst for YouTrading, and in today's video, I'm going to be taking a quick look across some of the main asset classes that I track and talking about a couple of potential trade ideas that I am monitoring at the moment. So let's jump straight into the charts here. We'll start with we'll start with euro dollar because this has been one of my favorite asset classes recently. Pretty much all of my calls in the last couple of months have been spot on. I've been calling that euro dollar is going to continually move lower within this sort of trend channel that we have here. And I've been saying for a long time that I expect that to continue for the foreseeable future amid continued number one, outperformance of the US economy versus the Eurozone, and number two, a more hawkish Fed than the ECB. Even though the ECB has been turning significantly more hawkish, uh, we're still talking about a terminal rate in the Eurozone that's well below what we're talking about in the US. Of course, the pace of this sell-off has accelerated in the last couple of days amid some sort of more localized weakness in pound sterling. I'll show you sterling in a minute, to do with concerns about the UK government's economic plan going forward, basically, after they announced massive spending and unfunded tax cuts last week in an effort to try and stimulate the economy in the next couple of years. And sterling weakness carries over and has hurt the euro as well. We have hit actually a target that I was talking about for a long time. I was saying we were going to hit this 0 spot 96 area, support resistance area, which we did hit um, earlier this week, and we've now found some support there. And if you look on the RSI here, the relative strength index, we're quite oversold now. So, you know, it seems to me quite likely now that you might get a bit of a technical rebound, perhaps back towards 0 spot 98. Anything that I see towards this area around 0 spot 99, because there's quite a lot of support there, a lot of resistance there, I would be very interested in the next couple of weeks. Um, we do have some events coming up this week. Let's just look at the calendar. Like, for example, we've got Eurozone flash uh, inflation estimates coming out next week, which are expected to be very, very hot, which you never know. That could spur some Eurozone upside on hawkish ECB bets, potentially. That could be one catalyst. Short covering as well. But I think the long-term trajectory of this pair remains to the downside, and I don't see us moving back above this parity level, which is around here in the near term. Um, let's look at US stocks now because they are testing a key area of support. And I think the way things are going from a fundamental perspective, um, there's a strong likelihood that if it's not this week, in the next couple of weeks, we might get a new breakout to fresh annual lows. Why am I saying that? Well, because it seems as though the global macro picture continues to deteriorate. Okay, yes, things are quite robust in the US. Like, look at this consumer confidence numbers that came out today. A bigger than expected increase in consumer confidence over the summer in August. But even so, the inflation picture in the US continues to worsen, and that is the dominant theme right now. And actually, just quickly back to the calendar, we do have this core PCE number coming out on Friday, which is expected to heat up quite significantly on a month-over-month basis, which would sort of back up that much hotter than expected core CPI we had earlier this week. Earlier this month, that triggered this sell-off actually on the 13th of September, and will almost certainly underscore the fact that the Fed continues to need to be very hawkish. We're now talking about a terminal interest rate of 4.5%. If this core CPI over the next couple of months doesn't start coming down, if it gets even worse, we could be even talking about something closer to 5%. And the worry is that, okay, the US economy is doing okay right now, but we've got this massively inverted yield curve, which has been a classic and consistent predictor of recessions. And you've got the Fed massively tightening. Like, yes, the economy might be strong right now, but for how long? That's the question that's building in people's heads. And as people start to not only increase their expectations about future interest rates, which have a negative impact on stock valuations, but as they also start to downgrade earnings growth estimates, this could further hit valuations, I think. And anyway, so this is why I'm thinking there might be a break below the annual lows. And the way I would want to play this is see the break, see it retrace, and then potentially load on some shorts, because you want to see the break, see the retrace, see it fail to get back above, or struggle at least, and then that's kind of your validation that the next move is probably going to be lower. And in terms of the next targets, I mean, obviously there's this 3,600 level, which would be one of the first areas to be hit. But really, you could be talking about 3,200. There's quite a lot of support in this area from 2020. Although that is a big drop. That is a big drop, and you probably would need bad news on the inflation front in order to justify that drop in the short term, anyway. Final asset class we'll look at oil. Seeing a modest recovery today as the US dollar sees a minor pullback from. Well, let me just show you actually the Dixie. Here it is, minor pullback from. Well, I mean, it's actually barely even in the red on the day, but yeah, it's just come back off those highs, which is helping the dollar, which is helping oil, which has been hit by the stronger dollar. But I think rallies continue to be subject to being sold. This 81 area looks like an area which might be a struggle to get back above, even if it does. Got the 21-day moving average here at 85. That's been a good level of resistance in recent weeks. Then just below 90, you got the 50-day moving average. And, I've said it time and time again, but since the start of the month, I think it's going to be difficult to justify oil going back above 90, given what I already said about how people are getting so much more worried now about the global growth outlook, which hits the outlook for oil demand. So I continue to think that as a result of increased expectations for this oncoming spate of global weakness / global recession, the next area that oil might be hitting is in the low 60s here. But we shall see. That is a fairly hefty move that, it might take until the end of the year to get to that kind of area if we do. But yeah, that's the area I'm looking at because it's also the next significant area of support. Anyway, guys, hope you enjoyed the video. I hope you found it useful, and I will see you all in the next one.